Two people can buy the same gallon of milk, pay the same utility bill, and fill up the same car with gas, yet one of them is carrying a much heavier financial burden. The reason has less to do with tax brackets than most people think. In practice, many of the largest costs faced by lower-income households never appear on a tax return at all. They appear as overdraft fees, interest payments, late charges, financing costs, expensive insurance premiums, and the countless penalties attached to living without a financial cushion. The system often charges the highest prices to the people with the least room for error. Money does something that is easy to overlook. It does not only buy products, it buys flexibility. Someone with savings can replace a broken appliance immediately, pay a bill before penalties appear, wait for a sale, buy in bulk, or avoid borrowing altogether. Someone without savings often has to solve the same problem under completely different conditions. The appliance still needs replacing. The bill still needs paying. The expense cannot wait. The difference is that urgency usually comes with a price. This is where the hidden tax begins. A family with cash reserves may pay the listed price. A family without reserves may pay the listed price plus interest, fees, financing costs, and penalties. The product is identical, but the final cost is not. The less financial margin someone has, the more expensive ordinary life tends to become. The pattern appears almost everywhere once you start looking for it. A person with money is often rewarded for having money. A person without money is frequently charged for lacking it. The rewards are rarely advertised as rewards, and the penalties are rarely described as penalties, but the mathematics are difficult to ignore. A simple emergency shows how quickly the gap forms. A car repair costs $1,000. For someone with a healthy emergency fund, the event is frustrating but temporary. The money leaves an account and life moves on. For someone living paycheck to paycheck, the same repair can trigger a completely different chain of events. The bill may be placed on a credit card, split into installments, or covered through a short-term loan. The repair still costs $1,000, but the final amount paid may be far higher. The problem is no longer the repair itself. The problem becomes the cost of accessing money. The same principle extends beyond emergencies. Consider everyday purchases. A household with extra cash can buy larger quantities when prices are low. They can purchase durable products that last longer. They can replace cheap items with better ones and spread the cost over years of use. A household operating with limited cash flow often has to focus on the immediate price tag rather than the long-term cost. The cheaper option may appear more affordable today, but if it needs to be replaced repeatedly, it often becomes the more expensive choice over time. The result is a strange economic reality. The people who would benefit most from lower costs frequently have the least access to them. Discounts often require upfront spending. Better financial products often require stronger credit profiles. Lower borrowing costs are usually offered to those who need borrowing the least. Many of the largest advantages in the financial system become available only after a person has already accumulated resources. Credit provides another example. Money itself has a price, and that price is called interest. Yet the cost of borrowing money is rarely the same for everyone. People with strong financial positions often qualify for lower rates. People under greater financial pressure frequently face higher rates. One group pays less for access to capital while the other pays more. Over years, that difference compounds quietly in the background. This creates an unusual situation where money behaves differently depending on how much of it you already have. For some people, money generates opportunities, reduces costs, and creates options. For others, money shortages generate fees, restrictions, and expensive decisions that would never exist under different circumstances. The hidden tax of poverty is not a single fee, a single institution, or a single policy. It is the accumulation of countless small costs that appear whenever financial flexibility disappears. Each individual charge may seem insignificant on its own. A late fee here, extra interest there, a missed discount, a higher premium, a financing charge. Viewed separately, they look small. Viewed together, they form a system of friction that quietly absorbs income before it has the chance to become wealth. The irony is that most people focus on the visible taxes deducted from a paycheck, while paying far less attention to these invisible costs. Yet for many households, the hidden taxes of scarcity can have a larger effect on financial progress than the taxes listed on any government form. At its core, the issue is not that poor people pay more official taxes. It is that they often pay more for the same mistakes, more for the same emergencies, more for the same access to money, and sometimes more for the same products. The financial system rewards flexibility, and flexibility usually comes from having resources available before they are needed. Once that pattern becomes visible, many everyday expenses start to look different. What appears to be a series of isolated costs is often part of a larger mechanism. The less margin a person has, the more expensive ordinary life becomes. And that may be one of the most powerful economic forces shaping financial outcomes today.